Do you feel like we are getting close, at least, to some kind of washout bottom?
You know, Brian, it's kind of like that family road trip that you and I have experienced as parents. They keep asking you in the back of the seat, "Are we there yet, Dad? Are we there yet?" And I think at this point in time, the answer is no. We did see, obviously, significant selling pressure yesterday. But when I go through and I just look at some basic indicators, percent of stocks above 200-day moving average, I look at RSI, I'll look at MACD, I'll even look at our 40-week technique. They're not at levels yet that are commensurate with historical washouts that you and I have talked about in 2020 or in 2018 at this point in time. So I think the answer is there's still more downside to go. And if I was to frame that up for you, Brian, if you just look at the chart of the S&P 500, you'll see there's a pretty well-defined head and shoulders top that has been formed. And the relief rally we saw 2 days ago was just that. We couldn't get back above that neckline at 41.23. And the measured downside objective of that head and shoulders top would suggest 3,500 to about 3,600-ish range as sort of that downside objective. So I do think we got about another, call it 10% or so before we can actually find, I think, a tradable bottom.
Yeah, bells and sirens don't ring at tops or bottoms. We kind of never know until we look back at history. So are you looking at those types of technical indicators, the moving average convergence divergence, the MACD that you had mentioned, the relative strength index, RSI? I mean, will there be some kind of white flag that you will see that you'll say, okay, that does look like the bottom?
Yeah, Brian, that white flag for us has historically been the data that comes out of our own proprietary data set that we've got here. And we look at our industry groups and how many of those industry groups are below what we would define as a 40-week moving average. And historically, when we've called those bottoms in 2020 and in 2018, right here on this show in the morning, we have found that we were somewhere between 0 and 10%. Now, an updated reading through yesterday shows that we're at 15%. So we don't often see that indicator stops at 15%. It usually, when it breaks 20, it goes somewhere between 0 and 10%, and we're at 15 now. So that's what I'll be watching. The only risk, Brian, is that indicator could go to 0 and stay there for a while, like it did in 2008, 2009 period. I'm not sure that's going to happen this time. I think this indicator is going to do a very good job of steering us into the market, but it's going to come from a lower level. And let me just also add, Brian, that I'm not changing my year-end price objective of 47.75 because I think once we hit this sort of washout point, we're going to get a very nice rally in this market. But again, it's going to start from a lower level.
What would be the catalyst if you are right? And by the way, over the years, you have been far more right than you've been wrong, Craig. You've called many things and other people went against you and you were right on the money. What would be the catalyst for that kind of surge back higher? I mean, what will change? Inflation's not going away.
Well, if we look at what happened with the hometown favorite at Target, right? They got inventory issues, they got cost pressures, they got those items happening. Those are more deflationary than inflationary. And if that starts spreading across the retail sector, some of these inflationary pressures could start to wane. I'd also suspect you'd see 10-year bond yields start to come down in price. And as all those pieces come together, it's going to become kind of a tug of war with the Fed. Are they still going to go ahead and keep raising, the rates? And if we continue to see those deflationary sort of trends build, rates are going to come down. And the fact that you got almost 8 25 basis point rate increases priced in, that's probably not going to be reality. And this plays out somewhat like a chicken and egg game with the Fed at this point in time. And you have less than 8 increases priced in.
Yeah, and I know the Fed will say that they're not political, and obviously, we can debate that all day long, but the reality is the economy looks like it's on the precipice. We have a big election coming in November. Sounds like you think the Fed could change their mind. I mean, right now, Jay Powell's saying we're going to cause pain and we're going to take this economy wherever it needs to go to bring down inflation. You wonder how much they're going to stick by that, Craig.
Yeah, I agree. And you just watch the market and then you watch consumers and you look at where a lot of the consumer spending comes from. People watch their portfolios. There's a lot of good retired people here in this country and they're watching these shows. And Brian, when they start seeing their portfolios go down in value, they're starting to make choices. in terms of how they're going to spend money, which again would be a sort of another deflationary type trend if they start pulling in the reins on the consumer spending.
Is there one thing more than anything else, Craig, that you are watching? Is there one pain point, one indicator, one signal, anything quickly that you can point to and look at the most closely?
The signal, Brian, is going to be my 40-week indicator and how many groups are still above that 40-week moving average. That is what I'll be watching here to see when that bottom actually is formed and is set. And that'll be the indicator for me.